Good afternoon, everyone. It's Joe Gordon with Gordon Asset Management here on Tuesday, June the 23rd for our weekly update. This is about the 13th or 14th week that we have done this, and appreciate all our clients and guests and friends attending. We've had some great feedback. Before we start, we're just again show the disclosures. We're not giving tax or investment advice or any advice of any kind. These are opinions. Trying to give you one place to go one every week with about 20 to 30 slides and a 20-minute presentation, basically to put a lot of good information in your hands and help you make better informed decisions or also exchange with us. You can follow us on YouTube. You simply just have to go to youtube.com and search Gordon Asset Management, and you can see this week's video as well as previous ones as well, including the slides, or you can sign up on wealthqb.com. When we started this as a pilot project, the initial invites for those that have signed up was to end June 30th. So we're going to send a link via email, and you'll have to re-sign up again to extend it indefinitely. We plan to go indefinitely just because a lot of people really like this format, and it's real easy to follow and understand given the very unique circumstances that we find ourselves in. So let's look at quickly coronavirus news. We have so many slides on this, we just really are kind of overwhelmed, but the key data point here is there was 30,000 cases, then it was 20,000 during the shutdown economies, and now that economies are opening up, cases are trending up to an average of 25,000 per day. The 7-day moving average is now increasing. You can see that in the graph over here to the right. But that's to be expected, as most of the states, except 3 or 4, are pretty much in some phase of opening up, including New York City. So obviously, we have more than double the cases than the next country. Brazil's about to hit 1 million as well, and we'll keep an eye on this. Last week, Jerome Powell and the previous week testified a good bit on Capitol Hill, and essentially he talked about the fact the generous $600 per week federal unemployment payment on top of whatever you qualify at the state level, was more than too generous for some workers. They encouraged them to stay at home, no incentive to work, make more money sitting at home and shopping online. So obviously there is some talk in the testimony that there'll be some form of extension. There is probably more likely going to be a payroll tax credit. Last week, 1.5 million new people filed for unemployment compensation, and we expect there to be a lot more as many public companies decide they need to trim a lot of the fat, so to speak, and in this new normal that they don't need as many people. We'll see. Basically, state and local governments are begging for help. Saw today's news, the governor of Michigan is wanting a bailout, even though she kept the economy shut down way longer than many others. We'll see what happens, but obviously there's a lot of public employees that were laid off, and then the states don't have revenue. I mean, think about all the lack of sales tax revenue in every state from bars and restaurants that were completely shuttered. But basically, the key thing on interest rates, we've had a lot of folks ask, there's really no way that they're going higher. We listen to a lot of folks, and Lacey Hunt, former chief accountant for the Dallas Fed, basically has shown international and national studies that show when countries get as in debt as we are now, with the Fed balance sheet north of 6 trillion, heading to possibly 8 trillion, and a deficit of probably 2 trillion to 3 trillion this year, is that it slows future growth and interest rates stay at zero bound. But he did say we're not even thinking about raising rates. So obviously that would be a guaranteed recession. Okay. So everyone's guessing how long it's going to take for the recovery. We don't know. No one knows. I will say this: if you look at hospitality industry, whether it's hotels or airlines, airlines didn't recover for 3 full years after 9/11 to the volumes of flights that were done prior to that crisis. So we'll just see how it comes back. We've got some slides on that coming up in a minute. And I think it's the key bullet here at the third one. There are parts that will struggle to return to the old ways of doing things. And And clearly there's some people that don't want to go back to work because they're fearful they'll get sick. A lot of companies are having to really, really reimagine how they have a lot of employees on premises. So one of my favorite slides is keep an eye on the economic recovery index here, and you can see in the far right, it has retraced 50% of its low, so an all-time low ever, even more so than the financial crisis of 08-09, but it's still retracing itself back. Just shows you things are moving in the right direction, but still there is concern about the speed of the recovery. So if you look at unemployment claims, continuing claims are over 20 million. There are a number of people receiving unemployment stabilized basically, but then there are big companies that are announcing layoffs, the banks. One of our key data points a couple of weeks ago is that Mike Mayo at Wells Fargo, a noted bank analyst, said that, look, banks are going to accelerate by 2 to 5 years the total transition to online banking because they had to during the shutdown. A lot of people adopted and adapted to that, and there's really no need for all the branches and therefore a lot of the employees. So we'll keep our eye on this one. So here, the U.S. Index of Consumer Sentiment, University of Michigan publishes, and you can see since 2000, all-time high, right before the tech bubble bursting, and then you go back into 2005-06, still not as high, but trending there. The financial crisis shaded in gray here as far as it fell, and then you can see over here in 2020 down to a reading of 78, and basically it's on its way back. It was 72 in May, but it was hovering around the 100 level in February with the markets at all-time highs. So retail sales rose a record, almost 18% in May. That's a good thing to see happening, but some of that was probably pent-up demand from March and April as everyone stayed at home and sat on their thumbs. So it was the largest monthly increase since they started keeping records in 1992, and spending on credit cards is back up. So that's all good. You can see the plummet down here just in late April, and then now we're back. So a little V-shaped recovery there in spending. So here's some good information. If you think about the highest beta stocks, it's the ones that fell the furthest to earth, and that was hotels. You can see here average occupancy over 60% February, March, and then shut down everything. Occupancy went to just north of 20%, and now it's back to just north of 40%. There's a saying in the hotel business and in the airline business that if you don't have average of 60% or better occupancy, you can't make money. So when you look at restaurant bookings, you can see they went basically down 100% and then slowly trickling up as states reopen. Home purchases are now spiking back to normal levels. There's a huge demand for single family housing. A data point we mentioned last week, and we actually just saw it reiterated again this week, is that a lot of folks that formerly wanted to live and crunch together in apartments and townhomes and downtown areas of their respective city basically decided sharing all that common space with strangers probably not healthy, so they want more space, single family homes, move into the suburbs. So that has started. We'll keep our eye on that, but in the Raleigh-Durham area is a data point here. The demand for single family housing is going through the roof, and of course that's accelerated by all-time lows in mortgage rates as well. So you look at U.S. travel, you can see down almost 90 to 100%, and it's slowly trickling back, making its way back. I think last Friday the TSA said they had over 500 to 600,000 people go through security. One thing that's going to stop the recovery from happening as V-shaped quickly as people hope is there's data showing that the richest people are spending less money. And so you can see here change in spending habits. The highest income earning quarter of Americans is spending about half of what they normally do. Well, let's face it, if you're a rich person in New York City, where you probably spend a lot of money in restaurants drinking fine wine, that's not happening. That hasn't happened. So it's only natural. Then you couldn't go out to restaurants. So a lot of people that have a lot of means are basically not spending as much, and that's down here and the top earning 25%. The next 25% is just above it, and you can see the bottom earners are actually spending more as a percentage of their income. But essentially, the people that are suffering the most are the low-wage service workers, especially in hospitality, that basically were not working. And that graph is here. You can see the bottom workers are bearing the brunt of the recession, and minorities have also been disproportionate. If you work in hospitality, service, retail, restaurants, hotels, travel, obviously there's been nothing going on. And we expect this to continue. Just in private conversations with clients and friends, a lot of people are telling us they're not really all that excited about getting on an airplane. And of course, the top one is they don't want to get on a cruise ship. So there's always hope, and everyone's kind of thrown second quarter data in the toilet. We'll see. There's hope for Q3 and Q4, but the jury's out. Nobody really knows. You just have to keep looking at the data weekly and monthly to get a trend line, and hopefully it will be moving in the right direction. You can see GDP declined 5.6%, biggest drop since 1946. Again, no surprise, everything was shut down. Growth rates in the third and fourth quarters are projected at 23 and 10% respectively, but again, that's the CBO. Lots of studies they put out, they get wrong. It's a guess. If you look at the global downturn, 93% of the countries, according to the World Bank, are in a recession right now, and that's really probably no surprise either. And you can see that graph here, all-time high, and even more so than in the 30s in the Depression, and certainly more than the financial crisis, when only 60% were back in 2008, 2009. So we'll just see what happens, but obviously it's about as worse as it's ever been for folks around the world. Germany's, the GDP in the Eurozone is down 7.4%. You can see that graphed here, and so forth. Germany's GDP decreased by almost 9% in Q1 versus just under 5% for the US. And that's something to keep an eye on. Germany's GDP is heavily export driven and heavily manufacturing. Think BMW, Mercedes. Okay, what about the Eurozone? What are they doing to respond to that? And you can see in the graph to the right, grants and loans, kind of the same playbook as we have had here in the US with the Fed and the Treasury. And by country, you can see who's doing the most: Bulgaria, Croatia, Greece, and all the way down, every country is listed. But the EU's announced $1.85 trillion. I wonder if that's euros or dollars, but they're about the same, about 10% apart, and with 750 billion earmarked for the COVID recovery. And some of the ones hit the hardest are also the weakest financially. So if you look at this graph, PMI, Purchasing Managers Index for manufacturing, you can see the sharp declines here to the far right because of the coronavirus. And you can see, though, that the spikes are increasing. Japan still hasn't turned around there in red. US is in the yellow or gold, and we're obviously turning around. Germany a little bit, Italy has turned around, China starting to turn around. So the sentiment's still negative, but basically, economies are opening up again, and anything below 50 is not a good number. So you can see we all have a ways to go to get back to trend line. So now we're talking about a two-phased recovery. First, the initial snapback, but then you enter the new normal. Growth is strong in the first phase as demand from depressed levels goes way up. In the second, there's these lingering scars where people have changed their behavior. And we were talking about what GCR means. We concluded global coronavirus recession, or you could say global consumer recession from this particular slide, since it's from Oxford Economics. It's anybody's guess. Now we look at the drag through 2021. You can see what was hoped that we'd have this recovery, a V-shape, but that's the May forecast. It doesn't look like it's going to be that good, but again, we'll just have to see. The CBO does say they think unemployment will still be just a tad under 16% in the third quarter when things start to stabilize. But again, there are a lot of big public companies that are hinting they're going to cut people, including the banks, including some of the big computer firms and so forth. And they're just going to have to assess how many people do we really need, or how many do we want coming back to work. So let's see what the market did quickly in closing last week. You can see through yesterday, the S&P is down a little bit less than 3% year to date. The NASDAQ index, which is where most of your tech and biotech names sit, is up just short of 17%, which is hard to believe. It's at all-time highs, and clearly I feel like the disconnect we're starting to see is almost reminding me of the tech bubble that had eventually burst back in 2000, 2002, and this would be the equivalent of 1999. And for there to be a rally, it's got to be led by small caps, typically out of recession. So that's what you see. But the Russell 2000 index down 14%. And you can see the Barclays aggregate index is up just under 6%. And again, that's because interest rates fall, bond prices rise. There's no real surprise there. But again, remember that NASDAQ is totally, you got a 30-point spread between small caps and the NASDAQ. So now let's look at returns by sector, data through June 22nd. As we've talked about the last 3 to 4 weeks, the biggest winner this quarter has been energy, up 35%, but still down 33% year to date. Some of you remember in slides we had in April that the price per barrel of oil actually went negative. Financials were doing a lot better, but they have flatlined. Again, there's going to be cuts, and that'll probably be good, but some have questioned whether they can sustain their dividends at zero interest rates. Year-to-date financials still down 22, although up 15 in the quarter. But now you start to see materials to shine. That's 25% economies opening up. But really, when you look at the market leaders, it's consumer discretionary up 33% for the quarter, and also technology up just under 30% for the quarter, which is competing almost to be the top winner. Healthcare up nicely. Every sector's up. Utilities probably the worst for the quarter, was up double digits, now single digits at 4.8, still down year to date. But we do expect REITs, real estate, and utilities to be market leaders going forward because of zero bound rates. But clearly, technology is not to be reckoned with as the clear leader by far. Now, looking internationally, you can see the global bond aggregate index up 3% versus 6 in the US. But you see developed markets, Europe, Australia, Far East, the EFI index down almost 12% year to date. Emerging markets down 10% year to date. It hasn't been good anywhere, and the only reason it looks relatively better in the US is because of tech. Okay, let me go back one. Here's the PE ratios of the S&P. Again, it's at 22 times. The 25-year average 16 times. We wish we had the slide. We'll probably get it for next week, where we actually carve out the 5 big megatechs from the S&P. They're trading at 30 times. That's what pushes it up from 16 towards 22. And they're trading at 30 times, but they're growing earnings at that level. The rest of the S&P 500, the other 495 names, really is trading at 16, 17 times. So we'll hopefully get that slide next week. So the average on the index is above one standard deviation, which is always a cause for concern. But I just think that the big megatechs are be given sort of like its utility now. So everybody has to have them, and so we'll see. And as we were talking about that, you can see here the share of the S&P 500 of the 5 mega cap tech companies has doubled in the last 7 years. The combined weighting was doubled over 7, and that's actually in 2015, I believe it was 6, 7 years ago when Jim Cramer coined the acronym FANG. But N stood for Netflix, but they're not in the 5 mega cap. It's Google, it's Facebook, it's Apple, it's Amazon, and it's Microsoft. So here, the index, they made up 11.6% in 2013. Now it's 22%, or over 20%. And that's what's moving tech and moving markets. So what about cash? There's a lot of cash on the sidelines, over $5 trillion currently invested in money markets in the US, nearly double 5 years ago. The biggest change in 3 months we've ever seen, the last 3 months. And then obviously, stocks could go higher as people have fear of missing out, FOMO. But 78% of managers out there say the market is clearly overvalued. Okay, so here's my favorite slide. It's the Wall Street Main Street disconnect. And we've had this up before, but bringing it back this week. And you can see here the market prices as measured by the S&P 500, over 3,000 on the S&P. But you see here the corporate profits after tax. There's the biggest disparity ever. That's not a good sign. Something usually normally has to happen. This last bullet says either the S&P 500 index goes down or earnings have to go up. We'll probably see earnings go up some, but this is a huge gap to rally from. And it's never been worse except back when the tech bubble burst, when we had extreme tech valuations back in 99, 2000. So this is the one we will keep having updated weekly because we really think it tells you a lot. So final thoughts on the economy. The consumer's back and going out. There's a pent-up demand. A lot of the high net worth households aren't spending a whole lot. That's not good for the service sector. We appear to be in a debt bubble. We'll see what kind of bailouts the states get from the feds. And also you have the lowest interest rates we've had on record. And Fed bond buying is basically, there's no price discovery, but also it's sent bond returns up higher because yields are way down. Stock valuations are high. They could go higher because people don't seem to care about valuations. Again, think 99. But we have high cash levels too, so we'll see. That may mean there'll be people buying on the dip. As all of you know, there's some new wrinkles in all the societal tensions. A new term everybody's heard, coronavirus derangement syndrome. It seems to be something that's out there to it because there are a lot of people affected by the stay-at-home economy, and it wasn't so much the virus, it was fallout from family tensions and drinking and mental illness, etc. So we still have market shocks that could happen, and I just remind you on this point, I was looking at these yesterday, but Amazon is north of 26, going to 2,700 bucks, I believe, this week. It was trading at 1,600 at the bottom in late March. So you could see a 40% retracement on even the big tech names if we have a market sell-off, which probably would be induced by a crisis level, hotspots, and virus cases going through the roof. That's the biggest thing that people are keeping their eye on. We could have some good news that is surprise to the upside, but essentially it looks like markets are priced for perfection. Okay, I'm trying to get my last slide. At any rate, that's it for today. If you have any questions, feel free to email me or any member of the firm. Thanks for your attendance. We hope this added some value to your day and your week as you reflect on your portfolio and wealth and decisions you want to make. Thanks and have a great day.